Big news in the SPAC world today. 26 Capital Acquisition Corp has filed for Chapter 11 bankruptcy, just 3 years after raising $275 million in its Nasdaq debut. This was the SPAC that promised to bring Okada Manila, one of Asia's biggest casino resorts, to Wall Street. Instead, the deal collapsed in court, creditors piled up, and now founder Jason Ader has even been stripped of control by a U.S. judge. To me, this underscores the harsh truth about the SPAC boom. Flashy mergers and quick cash sound exciting, but when the fundamentals don't add up, the house of cards eventually falls. Back in 2021, 26 Capital Acquisition Corp launched as part of the SPAC frenzy sweeping Wall Street. Investors poured billions into these blank check companies, hoping to ride the wave of quick deals and overnight riches. Jason Ader, a former Wall Street analyst turned casino investor, positioned 26 Capital as a gateway to bring major international gaming assets into the U.S. public markets. The centerpiece was Okada Manila, a glittering $3.3 billion casino resort in the Philippines, pitched as the crown jewel that would rival Las Vegas. The proposed merger valued the deal at nearly $2.6 billion and was marketed as a once-in-a-generation opportunity to connect American capital with Asia's booming entertainment industry. For a time, it looked like everything was lining up. Investors had cash, the SPAC had momentum, and the casino brand carried weight. But behind the scenes, the deal started to unravel. Okada Manila's ownership was embroiled in bitter disputes, with multiple parties claiming control. Legal battles across jurisdictions slowed everything to a crawl. Meanwhile, creditors who had been providing services to 26 Capital, law firms, accountants, PR agencies, even translators, were left waiting to be paid as the merger stalled. By 2023, what was supposed to be a blockbuster Nasdaq listing had turned into a courtroom drama with no clear end in sight. The collapse of 26 Capital isn't just another failed SPAC. It's a cautionary tale for an entire financial trend. At the height of the SPAC boom in 2020 and 2021, hundreds of these vehicles raised billions of dollars, promising easy access to public markets without the headaches of traditional IPOs. But the promise of speed often masked deeper problems. Unproven business models, weak due diligence, and ambitious valuations built more on hypes than reality. In the case of 26 Capital, the risks were especially glaring. A massive overseas casino tangled in ownership disputes was always going to invite regulatory and legal scrutiny. Yet the SPAC pressed ahead, spending millions on lawyers, consultants, and marketing as if success were inevitable. When the merger collapsed, the bill came due. By the time creditors stepped in, the company had burned through cash without delivering the one thing investors expected, a completed deal. What makes this story even striking is the court's decision to strip Jason Ader of control. That's not common in bankruptcy proceedings, and it signals just how little confidence the judge had in management's ability to salvage anything. For investors, it's another reminder that SPACs can be as risky as the assets they chase, and that headlines about billion-dollar casinos don't always translate to shareholder value. In the end, 26 Capital's bankruptcy isn't just about one failed casino merger. It's a symbol of how quickly financial fads can burn out. The SPAC craze promised a revolution, but for many investors, it delivered little more than broken deals and mounting losses. Jason Ader's fall from leading a billion-dollar dream to being sidelined by a judge shows just how brutal that reversal can be. For anyone watching from the sidelines, the lesson is clear. Flashy promises and Wall Street buzzwords can't replace solid fundamentals. Whether it's casinos, tech startups, or coffee chains, execution matters more than hype. If you found this story insightful, don't forget to subscribe to Brand Guy for more quick breakdowns of the biggest brand and business dramas shaping the world today.